All right, guys, what's going on? I have a very important video. I've seen this in the chat a lot. I've seen newbies on YouTube talk about it. Again, people in the chat. And even then, a lot of people who've been trading, they don't really understand how these levered ETFs work. So I want to talk about them. I want to talk about how you could play them, or more or less just how they work, so you could get a better understanding and avoid one of the biggest mistakes. Now, again, drop a like if you love me. If you like the video, if it helps you in any way, turn on post notifications and make sure you subscribe if you're new. So, getting into this, a lot of people try to go for these levered ETFs, and I'm going to start off with the biggest mistake people make is they look at it and they're like, okay, well, it's dropping. Sadly, they'll try to use their technicals and say, okay, it's hitting here, it's going to be a dead cat bounce or whatever, bullish ascending triangle, bull dick bear, whatever they want to call it, and they'll say, okay, it's going to bounce up. That's not how these work, just. And then the next one is that they're saying, oh, well, it's been down over some time, but look, when it hits bottoms, it bounces. But again, that's not how these work. And what I want to tell you guys, the biggest mistake I've seen people do is they're going long on this. They're going long on the UVXY. They're going long on these levered ETFs that are designed to go to zero. And yes, it may look appealing. Okay, it's dropping, it's dropping, it's dropping. It's going to bounce at some point and skyrocket and double. And then even worse, they pull up a 3-year chart and they're like, whoa, I could buy it at $8. It was just at 1,600 a share, 5,000 bucks a share. They get really excited. This is just typical. You're new to the game. And, again, 2016 doesn't seem long ago. I promise you the UVXY was not at $3,400. We were trading it. It was around the same price it is here today, because what happens when it reaches a certain price, I believe below $8 or $7 for a certain amount of trading days, they reverse split the stock, and then they raise the price back up to 20, 30 bucks, and they just issue more shares. It's a dilutive asset. It's designed like that. And if you would be, you might say, oh, well, why don't they tell you? They do tell you. If you look at the prospectus, you look at the filings for these companies, and these are products. These are financial products. Pro Shares is a company. They're offering you a product to trade, and you're pretty much agreeing to buy their asset that they're offering, and it's just supposed to operate like a company. Essentially, it's on the stock market, so you have to understand that. So again, if you're going long on these and you're buying them, don't do that. You're setting yourself up for a dramatic loss. If you're using a lot of money, if you're new and you're trying to go long with a couple $1,000s, you're using margin, this is a great way to destroy account, because these 3 times levered ETFs, they move really, really fast, and you're really going to just set yourself up for failure if a big move happens and you're not positioned correctly, simply from not understanding how these operate. So that being said, be very, very careful with them. Do not trade these in the sense of going long on them, or even long-term options, hoping that they're going to go up. Can you trade options on them? These are really used for day trading in and out, and people use these to hedge certain positions. But again, depending on your style of trading, you could find a better hedge than the UVXY. Again, there's different products that offer different hedging stuff. That's what these are, and it shouldn't be held as a stock to buy, and that's it. So getting into it now, let's talk about why these exist. How do they work? The number one thing a lot of people don't realize about the UVXY and stuff like the VIX, one, the VIX itself, the UVXY is a 3 times levered of the VIX. And now the VIX is still pretty active and moves a lot in and of itself. Why did this not show up? Let's link this to one. So here's the VIX, and you guys could see over time what it is. But again, it operates the same way. It's supposed to be a gauge of fear, more or less. And now, how does the VIX operate? And this is where you guys can know, this will help you out. The VIX is literally measuring the put to call ratio in the stock market. So essentially, when more puts are being purchased, the VIX is going to go up in value. That's indicating there's more fear in the market. When you start to see more calls being purchased, the VIX goes down because there's less puts being held, open interest versus calls, and that shows that people are more bullish. It drops the fear, and that's the gauge that people use in the market. The UVXY is pretty much a hyper VIX to go off of that. Again, 3 times levered. Now, What is the point of the VIX though in assets like the UVXY? You have to understand when you guys are seeing, I wish it was live so I could show you guys, on a level 2, but when you start to see trades being made, there's market makers are buying and buying and buying. They have these algorithms that buy certain events, or even then just to provide liquidity, they're spending a lot of money. It's not all the time when you see orders going through. It's not private participants like you and I just buying. It's other banks purchasing these high frequency trading ETFs owned by these financial institutions that are purchasing. So why they have the UVXY and VIX and why they have them levered 3 times levered. Imagine there's, an algorithm buying on the S&P, right? It buys S&P 500, or it'll buy a broader market index, or even a certain stock. To hedge themselves, the algorithm will automatically buy UVXY at the same time. That's why the UVXY and the stock market move kind of, really, it's an inverse relationship when you look at it. Here's the UVXY, or again, you could look at the VIX, and let's compare that with the SPY. Please hold. Come on. No love. I think I put the wrong one. There you go. Okay, that doesn't really give us a good why is it doing that? So I should have used my other platform, my other screen. I hate the new E-Trade layout. But in general, what you'll notice is that they kind of inverse. So pretty much, I don't know which one. This is saying the SPY. It doesn't look good, but pretty much when the SPY goes up, UVXY will go down and vice versa. And why that's occurring is because as these market makers and algorithms that automatically buy or sell, this is what they do. So if they start buying a lot of assets to hedge those positions that they're buying, they automatically buy the UVXY. So, or they'll automatically short the UVXY, or in general, they'll buy it as protection, or they short it on the vice versa. If they start selling a lot of stuff and they're trying to sell the market, they're going to start shorting the UVXY and vice versa. So, what they're trying to do is hedge themselves, or they'll buy another ETF that's levered to balance out the position, because then if they're buying $10 million of S&P 500, they could buy $1 million of UVXY to properly hedge their position. So they're either going to make money on one, or it'll get, if it starts to go down, they'll make money on the hedge that they're buying. So that is the purpose of these assets. It's for high frequency traders, big positions, big banks to buy them. Yes, can you get in on the action, scalp a few trades, especially with options? Yes, but if you're going long on them, you're setting yourself up for failure. Do not do that. Find something else to trade. Be careful of these UWTIs, DTIs, STDs, UTIs. That's all they are. It's only going to get you in trouble. So I'll leave it at that. I love you guys. Stay in school. Again, subscribe, drop me a comment. Love y'all.